Welcome back to the Legacy Radio Network. You're listening to Everything Financial Radio. We're here every week at this time, and we're certainly glad you joined us. I have the pleasure today of chatting with Mr. Pete Kendall. Pete is one of the editors of the Elliott Wave Financial Forecast. If you're just joining us, the Elliott Wave Financial Forecast is a publication of Elliott Wave International. And Pete, in the last segment, we talked a bit about this theory that really your group has kind of pioneered. It's called socionomics, and for anyone that maybe wasn't with us in the last segment, just briefly explain what socionomics is.
Socionomics is the study of social behavior with the use of the application of the wave principle, which is an approach discovered by R.N. Elliott. It's a specific technical approach contending that there are patterns within stock prices, very specific patterns, and it has implications beyond the market, because if the mood that drives stock prices is in place, as the theory contends, then it must also be affecting the larger social world. And socionomics is the study of and application of that principle.
Now, in your last newsletter, Pete, you discussed this theory in action. And I thought it was interesting that the quote that I'm going to read came from a 1991 issue of the Elliott Wave Theorist. And here's the quote. It says, "When government gets into the act of speculation, the top is usually way past having occurred. Government is the ultimate crowd, every decision being made by a committee. It's always acting on the last trend, the one that's already over." And you give an example that the government passed securities laws in 1934 to prevent the 1929 crash. It's reactionary. Now, recently, the Federal Reserve announced a money printing program that was unspecified and open-ended. We joked here on the show that this was quantitative easing to infinity and beyond, in a tribute to Buzz Lightyear from the animated movie. Is this action by the Federal Reserve a result of social mood?
Well, we believe it is. The quote is really a socionomic guideline, but at this point I think we might be able to make it more solid, because the evidence, or one of the evidences for it, was what took place in 1934. The horses were out of the barn, and the federal government came forward and closed the barn door to try and prevent a bear market that had already was actually over in 34, because the market rallied off a low in 32 and never looked back. And now in 2012, as you know, with QE3, they're opening the barn door in the beginning of or the front end anyway, of a bear market. And it's just completely absurd, because the horses are out. And what they should be doing, because there is a danger out there called what could happen in the bear market, is they should be heading for the barn. And if government was capable, which it's not, it would be encouraging this behavior. Now, what we showed in this study is that this is a remarkable expression of social mood in and of itself, what's taking place today in QE3, because it's a reversal from what took place throughout history up to this point in time. And we offer that this is because we're in a new phase, a new most serious part of the bear market. So government has changed its behavior. It feels compelled to act, as it has at social mood high extremes before, but it's doing so in the opposite fashion. What am I talking about? Okay, let's go back to the beginning of the Fed. That's really 1907. There's a panic and there's a response, which takes a few years. 1914, they finally managed to create this entity called the Fed. And its role. Now, as we state in here, it is at least partially a response to the panic of 1907. While I was doing the research, I was a little bit rushed, and I think I could establish that more firmly, that it was more than just partially a response to what took place in 1907. But let's just look at what we know objectively, and that is that we're at another low. It's 1914, everybody's panicking again, and they get through this entity called the Fed. Now, what happens in 29 is interesting. At this point, there's still a lot to go in this bull market. We still have what we call a whole super cycle bull market to come from 1932 to 2000. So the Fed really still has an understanding of its initial role, which is to be reactive and to try and reduce speculation. So there's an argument in the Fed of what they're going to do, but finally by August 1929, they raised the discount rate to 6%. And of course, it was 1 month later early September, that the stock market peaked and you had the crash 2 months after that. Then the big thing that happens is once the market bottoms, you get Glass-Steagall and margin requirements. For the first time, the Fed is given the power to raise the margin levels at the New York Stock Exchange.
And Pete, for those listeners that aren't familiar with margin levels, really a margin loan is when you borrow money to buy stocks, and the margin level really refers to the amount of collateral that you need to have. And in the 1920s, you really only needed to have 10 cents in your account to buy $1 worth of stock. And I think that the Fed, over the years, and give me your perspective on this, but once the Fed was given power in 1934 to determine what these margin levels should be, to stop speculation, they would maybe raise margin rates to 85%, and they were reduced to 50% here, and have stayed that way even through the boom of the 1990s, according to your newsletter. So, what prevented the Fed back in the 1990s? When Alan Greenspan, as I read in your newsletter, warned against irrational exuberance, that this party might be going too far too fast. What prevented him from raising margin limits then?
Okay, you kind of go into the 50s, or actually at 37, they raised the margin level to 55%. In 1966, the next major peak, they raised it. Actually, it was 68. They raised it to 80%. And then now, what happens in the next phase of the bull market, which is actually begins in the 70s and 80s. The Fed becomes completely disinterested in raising margin requirements. They say it doesn't work. In 1984, they put out a paper and say margin isn't effective anymore. So this is actually a function of there having been a bull market for 60 years. Now, in 2000, they did sort of there was a question raised because, well, that was the greatest mania in history, and margin levels were rising, or use of margin was rising to an extreme. So they did have a discussion, but the Fed said they talked about it, but they did not raise the margin level. They chose to leave it where it was and never look back. Now they did raise the discount rate to 6%, so they still felt some responsibility in trying to calm the situation. Again, in 2007, they raised the level to 6.25 in 2006. And then finally, however, a funny thing happened. 2 months before the all-time peak in the Dow, the Fed lowered the discount rate to 5.75%. So something a little different there. And also, into 2007 and 8, we started getting bailouts like almost immediately. So the behaviors, there's this kind of a shift in that we're very near a price extreme in stocks, and yet the Fed is acting to boost stocks instead of spike. In the 60s, the Fed chairman said his job was to pull the punch bowl away when the party gets going. And at this point, especially right now, with the Dow pushing against these long-term extremes, the Fed is spiking the punch bowl.
So essentially, the Fed has gone from actually having the job of being the watchdog, of making sure speculation doesn't run rampant, and now they're trying to actually get people to speculate. In fact, I think Bernanke said something that when people's 401ks are going up, they feel wealthy and they spend more money.
Yeah, it's just blatant, and it's out of character, out of really the agenda that the Fed was established to its function, really.
So, Pete, let me ask this, because in your newsletter you say the Fed will pay a steep price for, and I'm quoting, goosing the old trend near its end and fighting the new trend as it begins. And I take that to mean that the Fed's trying to goose this bull market, and in your view, the new trend is a bear market. In fact, this rally that we've seen is a bear market rally. So when you say the Fed will pay a steep price, what exactly do you mean?
Well, we're speaking specifically to how it will be regarded in history and by the public. One of the socioeconomic observations that we've made is that people that are lionized in bull markets tend to have the pedestal kicked out from under them in bear markets. So if you receive the brunt of the optimism, so to speak, if you benefit greatly from it, which I don't know if you'll recall, but in 2000, Alan Greenspan was called the maestro, and again in 2007, Bernanke was mostly revered. At this point, that his iconic image is starting to crack a little bit, and what we're suggesting is that at the end in the next phase of the bear market, the Fed will be criticized broadly for its actions.
You know, in your newsletter, I'd like to shift gears a minute. You talk about cultural trends, and that really ties into the whole economic theory, the whole study of socioeconomics. And you mentioned, it caught my eye, you mentioned something that was a growing interest in the slow life. Can you explain to listeners a bit about what you wrote there and what you meant?
Yeah, it was just kind of an observation that in different areas you're seeing a sudden, where there was a need for speed, there's a need to suddenly slam on the brakes. I don't know how to put it other than that. One example that we cited would be high-speed trading. All of a sudden, we're seeing a lot of different, even the high-speed traders themselves, some of them at least, are saying, this is just too fast, and we need to slam on the brakes here, which they are doing in various ways. Suddenly, there's a lot of impetus to actually government intervention or speed bumps, maybe regulators, but if they don't do a good job of it, you could see the government getting involved, I'm quite sure. Another area is just, this one we didn't have in the newsletter, but I just realized it certainly applies. The high-speed rail is basically coming off the rails in China. Long article very recently, I think in the New Yorker, about they've reduced they've literally reduced the speed of the high-speed rail in China, which has been an enormous public project over the course of the last 3 or 4 years. Particularly, a lot of stimulus went into it, but it turns out it's rife with graft, and that is in itself a socioeconomic response to in the transition to a bear market. Scams and scandals will proliferate, and in China, ultimately, it could lead to change in government, and so that's taking place there. Meanwhile, there's something called the slow life. It started kind of quietly in 1989 with something called the slow food movement. In '99, when we were closer to the peak in stocks, there was a World Institute of Slowness that was established in 2005. Started to get books about the cult of speed, and now finally in 2008, when we were in our first bear market phase, the New York Times wrote an article about the slow life picking up speed. Basically, the slow food movement branching out, and so at this point, we think we've cited several areas where we think you're starting to see that kick in, where people are saying, "Hey, we need to slow down here." The headlines are being quite insistent. In fact, "Slow down," says the Times of India headline from September 23rd, for instance.
Well, Pete Kendall, that's all the time we have for today. Pete is one of the co-editors of the Elliott Wave Financial Forecast, the publication of Elliott Wave International. And Pete, we certainly appreciate your time today, and we hope you'll come back.
Oh, I hope so. Thank you, Dennis.
Everything Financial Radio will return after these words. Stay with us.